Welcome everybody to the last minute 2022 tax moves webinar. My name is Justin Rucci. I'm a certified financial planner at Orange Street. Alongside me today is Emily Bell-Mages, also a certified financial planner. And today we're going to go over some items to consider when starting to prepare for your 2022 tax return. Before we get started, just a quick disclosure. We are a registered investment advisor. So if you would like a copy of our Form ADV, feel free to either give us a call or send us an email. We're happy to send you that. So here's the team. Again, this presentation is done by myself and Emily, the two on the far left here, but we do work as an ensemble. So everybody has their own set area of expertise. Emily and I are financial planners, but behind the scenes, we have client service people, operations people, investment specific people. So everybody has their own area of expertise and we work as a team. So the first item is just a quick reminder as to what the tax deadline is. This year it is April 18th. It is typically April 15th, just depends on what day of the week that date falls on. So for 2022 tax filing season, it's actually April 18th. So you should start receiving documents in the mail or your email soon if you have not already. If you are a full-time employee, you will receive a W-2. If you have investment accounts, you'll receive a 1099, either a 1099-R for IRAs or 401k distributions, or maybe a 1099-B or a DIV if you have a taxable brokerage account. Those are the most common forms, but certainly if you itemize, which is becoming more and more rare, at least on the federal level, certainly at the California level, a little bit more common. But if you itemize, you want to start gathering some of those items as well: property tax, state tax, potentially medical bills, and some of those other itemized deduction potentials. One thing to keep in mind, this is new and specific to 2022 tax filing season. There is an extension that was put into place. So while the typical tax deadline is actually April 18th, for most California taxpayers, it's actually going to be May 15th. And that was put in place due to natural disaster reaction, so flooding, mudslides, et cetera, that took place. It actually impacts the majority of California. If you're watching this webinar, you're most likely either in Los Angeles, Orange, or San Bernardino counties. All three of those counties are, in fact, eligible to delay their filing to May 15th. That said, if you're expecting a refund, you might not want to delay because obviously you might want that money sooner rather than later. So if you owe, it might make sense to wait until the deadline. But if you're expecting a refund, you probably want to file as soon as you're able to. In terms of actual tax moves that you can still do for the 2022 tax year, a traditional IRA can be filed or can be contributed to up into the filing date. And there is an income limitation. So the income limitation is on the screen. It is somewhat low, but there are exceptions to these income limits. So if you do not have a plan through your employer, then these limits are higher. And this is, bear in mind, to contribute to a traditional IRA and take a tax deduction for it. So that's why the income limitation is so low. One thing that we do see probably more often than the traditional IRA contribution as a more, I guess, normal approach is a traditional IRA contribution for individuals who have retired recently. So this, if you retired recently, maybe you had a partial year payout. And so because you only had income for part of a year, you're under those income limitations from the previous screen. But because you have income for a partial year, you have W-2 income to justify making the IRA contribution. So kind of a nuanced situation, but it applies to a fair amount of our clients when they retire mid-year, or if they retire at the end of the year, but maybe have a bonus or something paid out in the following calendar year. You might have some W-2 employment income that qualifies for an IRA contribution, but keeps you below the income limitation for being able to take the tax deduction. So again, if you want to make a contribution and you meet all the criteria, the limit for 2022 is $6,000 for individuals. If you are over the age of 50, which chances are, if this retirement specific scenario applies to you, you are, that income goes up, or that contribution limit goes up to $7,000. So SEP IRAs and small business plans typically are solo or self-employed 401ks. Those have much higher contribution limits because if you are self-employed, this is most likely your only retirement option. You can contribute up to $61,000 with no income limitations at all, and you have up until tax filing deadline to do this. This will vary a little bit depending on how your business is structured. If you're an S Corp, for example, you might want to have to amended W-2 to show part of a 401k contribution on your W-2, certainly reach out to us or reach out to your tax preparer if this is something that you want to do and you haven't made a contribution yet for 2022. And lastly here, Roth IRA is another common one. So if your income is too high for a traditional IRA, but you still want to do something, you might qualify for a Roth IRA. A Roth IRA does not give you an immediate tax write-off, so it's not going to give you a tax write-off for 2022. But what it does do is it allows you to contribute money into an account that's tax advantaged, as long as you meet the criteria when you withdraw it, which is post age 59 and a half and the account having been open for 5 years or more, those distributions will be tax-free. So the income limitation is higher on this one because you're not getting a tax deduction. So it starts at 129 for single, goes to 144, and then 204 to 214 for married. The way these phase out ranges work is if you were under the lower part, so if you're under 129 or under 204, you can contribute the full 6,000 or 7,000. If you were over 214 or 144, you can't contribute at all. If you're in between, you're basically phased out partially, and so you can contribute a portion of the contribution limit, and that calculation is done based on kind of where you fall in between that range. The closer you are to the upper limit, the smaller your contribution would be. There is still a workaround to this income limitation for Roth IRAs. It's called the backdoor Roth IRA option. It's been on the chopping block in Congress for a while now, but it actually survived the most recent legislation that they passed for retirement plans. So it'll likely be around at least for the foreseeable future. And this allows you to contribute to a traditional IRA and then immediately convert it to a Roth IRA. Now, this works best if you don't have any pre-existing traditional IRA money. So definitely make sure that you either work with us or work with your tax preparer if that's something that you want to do, and we can handle the logistics of that for you. So again, contribution limits are the same for Roth, 6,000 or 7,000. These contribution limits are aggregated, meaning if you contribute to both a traditional and a Roth IRA, for whatever reason, it's 6,000 combined or 7,000 combined between the two accounts. You cannot contribute that full account limit to both. So next, I'm going to pass it over to Emily, and she's going to go over health savings account contributions, some other items to keep in mind.
Hi, everyone. Thanks for joining us today. For those of you who have a high deductible health plan that is HSA eligible, you have until the tax filing deadline to make your prior year HSA contribution. A reminder that HSA contributions receive a triple tax benefit. The contributions are tax deductible, the investment growth is tax-free, and withdrawals are tax-free if the funds are used for qualified medical expenses. One note that once you're on Medicare, you can no longer contribute to an HSA. You can, however, use your HSA to pay for Medicare premiums. Okay, and this is regarding extensions. Many of our clients do end up extending their tax returns until the October deadline, which for 2022 tax returns is October 16th. And a reminder that if you do extend, your tax due is still due by the April or May deadline. And so you'd want to work with your CPA to determine how much you should pay as an extension payment if you do decide to extend your tax return to the October deadline. And this isn't 2022 news, it's 2023 news, but it's big enough news we thought we would put onto everyone's radar here. Secure Act 2.0 was passed in December 2022, and the biggest change in terms of tax planning was the increase in age for RMDs, which are the required amounts you need to withdraw from your IRAs and retirement accounts. Those changes start this year in 2023, where the RMD age has been pushed back to 73. And then, as you can see, in 2033, the RMD age increases again to age 75. This is an overview of our client onboarding process, what clients can expect when they work with Warren Street. You can see that we start with an initial call to see if we're a good fit for each other. And if so, we work through the process to ultimately implementing financial planning solutions together. So this is just kind of an overview of that initial process clients receive when they come on board. This is a quick overview of our investment strategy. You can see that diversification is at the core of our strategy. We employ a stock strategy, bond strategy, and diversifier strategy within client portfolios. And this is an overview of our financial planning standard of care. These are the financial planning topics that we address with all of our clients as applicable. These are built into our quarterly reviews and annual reviews and also our internal processes. And we have subject matter expertise on these topics. This is a quick overview of our fee schedule. You can find this on our website as well. And you can see that what's an ideal client for Warren Street. Quick bullet point list there. Someone who wants to delegate their financial management is kind of ready for some professional help and values the integration of financial planning and investments under one roof. And then wants a long-term partnership. We see our clients as family, and we're looking for those kind of long-term relationships. This is source material. And this is, if you want to reach out to us various ways, you can book with us directly online, give us a call, there's our main line, and certainly email us to our general email address there. Really appreciate you taking the time to join us today, and would love to talk to any of you, any existing clients with follow-up questions, or any prospective clients who want to explore Warren Street further. And now we're going to open up the floor to questions. And let's see, I'll turn it over to Justin at this point to start fielding questions.
Thank you. If you have a question, feel free to put it in the chat box or email us. Again, I'll jump back to the previous slide with our contact information. Give us a call, email us if you have any questions. If you're already working with us, feel free to reach out directly to your advisor. Or if you have some questions you'd like us to answer on the spot, use the chat box below, and we'll hang around for a few minutes to answer those. Thank you very much for attending, and hope to talk to you all soon.